Imagine this. You're sitting at your desk, scrolling through the news, and suddenly you see a headline, the jobs report that could change everything. Your heart skips a beat. Why? Because in the world of finance and economics, the non-farm payroll report can single-handedly shake up the markets, affect the job market, and even determine the future of interest rates. But why does a single report hold so much power? And how does it impact you? Whether you're an investor, a worker, or just someone who wants to understand what's going on in the economy. Well, that's exactly what we're diving into today. Stick around, because by the end of this video, you'll understand why the non-farm payroll is so important and how it can change everything. First off, let's break down what the Non-Farm Payroll (NFP) report actually is. Put simply, the NFP is a monthly report released by the U.S. Bureau of Labor Statistics that provides a snapshot of the employment situation in the U.S. economy. It tells us how many jobs were added or lost in a month, excluding agricultural jobs, government employees, private household workers, and non-profit organization employees. Why exclude those? Well, the reasoning is that these sectors tend to be more volatile and less representative of the broader economy. The report instead focuses on jobs in industries like manufacturing, services, construction, and technology, industries that are directly tied to economic growth and stability. In other words, NFP is like a report card for the U.S. job market. It gives economists, policymakers, and investors a clear picture of how the economy is performing in terms of employment. Now that we know what it is, let's talk about why it matters. Every time the NFP report is released, the financial world holds its breath. And there's a reason for that. This report gives us critical information about the health of the U.S. economy. Here's why it's such a big deal. 1. Economic growth and stability. If the NFP shows that a significant number of jobs were created, it's a sign that the economy is growing and businesses are hiring. Conversely, a drop in job numbers can signal economic slowdown, layoffs, or even a potential recession. 2. Fed's decisions. The Federal Reserve, which controls U.S. monetary policy, pays close attention to the NFP report. If jobs are growing rapidly, the Fed might consider raising interest rates to prevent the economy from overheating. If job growth is slowing, the Fed might lower rates to stimulate the economy. 3. Market reactions. Stock markets, bond markets, and the dollar all react to the NFP report. For example, strong job growth could lead to a rally in stocks, as it signals economic optimism. On the other hand, weak job growth might make investors nervous, causing market volatility. So, the NFP is like the canary in the coal mine, signaling potential changes in the economy, the markets, and the policies that affect us all. All right, you might be thinking, okay, this sounds important, but how does this affect me? Well, let me explain. For investors, the NFP report is one of the most critical economic indicators. It directly impacts stock prices, bond yields, and even commodities like gold and oil. If the report shows strong job growth, stocks might go up as investors feel more confident in the economy. Conversely, weak job numbers might cause stock prices to fall. For workers or those seeking employment, the NFP gives an idea of how competitive the job market is. If job growth is strong, there are more opportunities out there. If the report shows job losses, it might signal tougher competition and lower wages in certain sectors. And, for policymakers, The NFP is a tool to gauge how well their policies are working. If the economy is struggling, they might use the report to justify actions like stimulus packages or lowering interest rates to boost job creation. Bottom line, whether you're an investor, worker, or policymaker, the Non-Farm Payroll report shapes the decisions you make about money, career, and the future. Let's get a bit deeper into the economic implications. When the NFP comes out, it sends signals to the Federal Reserve about how much inflationary pressure exists in the economy. If jobs are plentiful, wages tend to rise because companies are competing for talent. When wages rise, consumers have more money to spend, which can lead to inflation, the general increase in prices of goods and services. This is when the Federal Reserve steps in. If inflation is rising too fast, the Fed might raise interest rates to cool down the economy. But if job growth is weak and inflation is under control, they might lower interest rates to encourage borrowing and investment. The NFP report also shows where the job growth is happening. If it's in high-paying sectors like technology or healthcare, it could be a sign of a robust and evolving economy. If job growth is concentrated in low-wage sectors, it might signal economic imbalance or a lack of opportunity for skilled workers. Now here's the real kicker. These decisions affect everyone. From mortgage rates to credit card interest rates, the Fed's reaction to the NFP can change the way we manage our finances and make investment choices. Let's take a look at how the NFP report has influenced markets in the past. One standout example is during the COVID-19 pandemic. In April 2020, the U.S. lost over 20 million jobs, the largest job loss in history. This report sent shockwaves through the market and the global economy. The stock market crashed, and policymakers quickly acted with stimulus packages to prevent further economic damage. On the flip side, the August 2021 NFP showed strong job growth, with over 943,000 jobs added to the economy. This sent markets soaring, boosting investor confidence and leading to a rebound in stock prices. These examples show just how much market sentiment can change based on the NFP report. It's not just about numbers, it's about perception. The perception that things are either improving or deteriorating. So what can we take away from all this? The Non-Farm Payroll report isn't just a set of numbers. It's a snapshot of the U.S. economy, and it holds the key to understanding everything from inflation to interest rates to your job prospects. If you found this video helpful, make sure to like, share, and subscribe to stay updated on the latest economic trends and market movements. Drop your thoughts in the comments below. Do you think the next NFP report will change everything? Or are we in for a more stable market? Thanks for watching. And remember, knowledge is power. The more you understand how these reports shape the economy, the better prepared you'll be to navigate the markets and make informed financial decisions.